everyone. We wanted to take a quick moment to thank you all for joining us today. This podcast was recorded and is made available to you by Whitley Penn LLP and WP Wealth LLP solely for informational purposes. The information, views, and opinions expressed in this podcast are general in nature and are not intended to be construed as the provision of financial or investment advice by Whitley Penn or WP Wealth. The information discussed in this podcast is accurate as of the day it was recorded, but may then become outdated over time. Please feel free to contact us if you have any questions, comments, or concerns in regard to the content presented. Thank you again for tuning in, and we hope you enjoy this episode.
Hello, everyone. Thanks for tuning in today. My name is Bree Miller, an advisor with our WP Wealth Group, and I am excited to host this very special episode of WP Talks. I hope you've been following along with our recent series where Tom and I have put together timely updates on the state of our economy and the markets as we experience the effects of the COVID-19 pandemic in the spring of 2020, the quick recovery in the markets as a result of government stimulus, a change in administration, and now an economy that is opening back up with, new emerging inflation concerns and potential significant legislative policies that could have significant impacts on individuals and businesses. To piggyback off of some of the discussions that Tom and I have had on previous episodes, we thought it would be interesting for our listeners to hear from other leaders of different service lines at Whitley Penn. So today we are joined again by Tom Rein, managing partner of our WP Wealth Group, WP Richardson, Whitley Penn's Director of Insurance, and Robert Allen, a director in our Forensic Litigation and Valuation Services Group. All of these leaders in various service lines of Whitley Penn provide guidance to clients on different areas of their financial world, and we thought what a great opportunity to hear from them as to how their clients are perceiving all of the changes in this environment and the impact to their businesses, and to get their perspective on changes that are coming about. So I think a great place to start is maybe we'll go around to each of you and have you share some of the conversations you're having with clients, colleagues, friends, and families in reaction to some of the trends we're seeing in the economy and the markets, or proposed policy changes we're hearing from the Biden administration. So what are they concerned about? What are they looking to you for advice on? Tom, let's start with you.
Great. Thanks, Bree. We've shared in previous podcasts a lot of the details of change over the last 18 months. And it's amazing when you think back of what we've lived through, just both personally and in business and in each of our service lines. But maybe kind of focusing on maybe real time, what are some of the conversations or more prevalent conversations we're having today, 18 months past shutdown of the economy and all the changes that we've seen and talked about. I think they all kind of center around just the unknown, confusion and uncertainty about the future. Specifically in our WP Wealth Group, we work with a lot of retirees or soon to be retirees that, typically at that stage of life are deleveraging, maybe taking some risk down and kind of putting themselves in a position to enter a new stage in their financial journey. And part of that is, maybe investing a little more safely in more interest sensitive type investments. And so one of the big concerns or discussions that we have is, how do you generate a real rate of return given the low interest rate environment and high inflation? As portfolios take a different slant to a more conservative approach, retirees are very concerned about, outliving their money and how their accumulated assets are going to provide for them. So I think that's one thing that definitely spend an awful lot of time talking to clients and also talking internally within our group. I think another big topic of conversation today that we're having is just the seemingly historically high risk appetite that we're seeing in the marketplace, whether that be in some of the meme stocks or some of the cryptos, the evolution of Robinhood and all the new investors that have entered capital markets that it seems to be a situation where people don't perceive risk. They think markets only go up. That's concerning to clients, and we spend an awful lot of time talking about that. And then, of course, and I know we'll spend some time today digging deeper, is all the information we're getting about all the various proposed tax policy changes, both individually to income taxes and businesses, and also gift and estate tax. One of the big parts of the consulting part of our practice is advising high net worth clients on estate planning, giving strategies, and things like that. And there's several different proposals out there, all with pretty significant changes from current law, and clients are very concerned about those changes and how to navigate with the uncertainty about whether something's going to pass or not, and whether we should be proactive and do something in advance of that. So maybe at 30,000 feet, those are some of the headline items that we're spending more time today addressing with clients than maybe we have in the past.
WP, what kind of conversations are you hearing and having?
I've had clients, and I've also talked to advisors, and they've been asked by their clients or friends, should they plan now, or should they wait to see what happens with the tax law changes and what's going to pass? That's been a question, I think, over the years that I've been in the business. Every time there's an administration change, tax law changes are coming. People always, the question is, do I do planning now or do I wait? So I think that's going to continue. I've seen that, and like I said, talk to advisors. That's a question that they're getting asked a lot right now. One thing that comes to mind for me on the insurance side is COVID. COVID has affected people in so many different ways, but I've had clients and friends ask me questions, and they've asked, will it affect the policies that they currently have, or will it make insurance a little bit more difficult to get in the future? I tell them that the policies they currently have, they're going to pay off. If somebody were to get COVID and they die from it, the insurance companies are going to pay the claim. They're not going to try to avoid paying that claim. COVID also has affected life insurance companies because of the unforeseen deaths that has been caused by the pandemic. And most of these deaths have occurred before that person's life expectancy. You see it all the time. I've seen it on the news that you have a 40-year-old person that didn't even have underlying issues that passed away. Well, that's going to be a claim that would be paid that normally wouldn't have been a claim that would have been paid because they're not even close to their life expectancy. Another issue that comes to mind is, what side effects is the virus going to cause that is going to be an issue with health in the future that make it difficult to get insurance policies, and when you apply for them, so harder to qualify for the insurance, and then also you may not even be able to get the insurance. So it's kind of an unknown of what these side effects and what they could do to people's health in the long run.
Interesting. Yeah, I didn't really think about how COVID would relate to underwriting or the payout of the policies already in place. So that's good thoughts. Robert, what about you?
Yeah, to some degree, the conversations I'm having with clients are really no different than the conversations I've always had. We're always trying to help business owners reduce uncertainty when it comes to the question of how much is my business worth, so that they can go forward and make better planning decisions. So that's always a challenge. It's still a challenge today. The context in which we're having those discussions more and more relates to what we've talked about here already, which is we've got a high asset value environment. We've got the prospect of less favorable tax laws coming down the pike. And the combination of those two is causing a lot of clients, business owner clients in particular, to revisit some of the conversations maybe they've had previously with other advisors or their attorneys about estate planning, about potentially gifting or moving some of the ownership of their business out of their estate under the current laws that are more favorable than what potentially may be coming in the near future.
Yeah, those are all very relevant topics and questions, we're all getting every day. Tom, could you just kind of summarize some of those larger themes and, really the headlines we're hearing? And then that might lead us into deeper conversations with WP and yourself and Robert that are specific guidance that you're providing your clients.
Yeah, I think some of this kind of responds back to the questions that I kind of I illustrated earlier, and I know many of these particular headlines affect businesses differently, and I know they may affect WP and what he does differently than what they do Robert in his business. But I think just to go down a list and maybe add a little color to each one. First of all, is interest rates. What we've seen in the last couple weeks is kind of head scratching. So, the conversation through the spring and into the summer has been inflation and, CPI and PPI coming in even above what the Fed expected, which was certainly elevated. The expectations were elevated because of all the financial and fiscal stimulus that has been put out there, the pent up demand, the supply chain bottlenecks that were creating really pressure on goods and services that were elevating prices. And you would have imagined, and we in fact did see interest rates begin elevating, which was in coordination with higher prices and with inflation. But in the last couple of weeks, interest rates have really spun on their heels and headed back down again to levels that we haven't seen, since the COVID shutdown. And that doesn't make sense. And I think everybody's trying to understand, what that means. The only thing you can say about the interest rate environment that we know with some level of certainty is that it's been manipulated through through Fed policy for many, many years now. True market conditions aren't necessarily dictating rates, but the reversal is kind of confounding. It would lead you to believe that maybe the strength of the recovery is waning, which is a sign of lower interest rates. So we're really kind of keeping our eye on that. I know it affects people's businesses. I talked about retirees with a larger percentage of their asset allocation earmarked towards interest-sensitive investments. And so while you have interest rates coming down, which affects the amount of income they receive, at the same time inflation going up, that typically doesn't work in that direction. So a little concerning there. We're hearing again this week on next round of government spending programs. There was a bipartisan plan for an infrastructure of around $1 trillion. We're hearing another backup once that's done of another $3.5 trillion. That tells me there's going to be more liquidity. So we have concerns about inflation. This doesn't help that at all. You wonder whether at some point all this spending, the marginal returns on economic growth get muted a bit. And this is a price, this debt we're taking on is something future generations will have to deal with in higher taxes and interest service. That's something that we're seeing and trying to analyze the long-term impact of that. Robert mentioned elevated asset prices. I think I mentioned that earlier, certainly in other podcasts. We're sitting at all-time highs at a time when there's still 9 million less employed today than there were pre-COVID. So while there's a lot of pent-up demand coming out of the lockdown into the opening of the economy, there's a kind of a disconnect between asset prices, and the only thing you can relate that to is the amount of liquidity, and a lot of that is going into assets which are being inflated. Risk appetite, I mentioned that a little earlier. The risk appetite seems to be just off the charts high right now. The attention to risk return, to managing risk return is kind of out the window. That typically doesn't end well for those that are losing sight of a balance and risk perspective. So we'll see how that plays out. It never happens at an opportune time, and it typically happens when you're most exposed. So those that are losing sight of that, be cautious. Inflation, we talked about. In recent weeks we've got CPI, PPI data, all that coming in at elevated levels and even above what was expected. Chairman Powell continues to reiterate that he thinks it's transitory. Hope he's right. Hopefully we start seeing some relief on housing prices and cars and any durable goods. Restaurants, are having to move prices up. Seeing in the grocery stores, certainly a concern. And then, the big items, just tax reform. I think with the $3.5 trillion spend package on social infrastructure, as they call it, those will have pay-fors as a tag along with that legislation. So at that point, we're going to start getting into, whether any of these proposals, whether it's the Biden proposal or the Sanders or some of the other proposals out there, are actually going to make law, and how the marketplace receives that, and how the market reacts to it, whether it's the elevated capital gains rate, the income tax rate, some of the gifting and estate tax changes. So those are some big headlines that we've just been introduced to over the last several months. People have different opinions as to whether there's enough support to make those through, but as we start talking about them in more serious context, we'll see whether the market responds or reacts to it. So again, some of the headlines that we all are reading and hearing about and thinking about, those are some of the things that obviously our group spends a lot of time trying to understand so we can advise our clients appropriately in light of that.
Yeah, that's really a great highlight reel for the news cycle we've all been hearing over the past year or so. And to your point, conversations I know we're certainly having with clients on the wealth side. One topic I'm going to pull from that list is interest rates. We've talked about the current interest rate environment and eventual, whenever that may be, rise in interest rates and how that might happen, but the effect it would have on markets, personal and business balance sheets. WP, I know interest rates are a cause of many conversations or proactive planning you're doing with your clients on the insurance side. Can you tell us a little bit about that?
Yeah, the life insurance companies, they've been affected by this low interest rate environment that we've been in for quite some time now. Low interest rates have caused lower investment returns for the life insurance companies, but it's also affected the policy holders. And I'm going to give an example of using two type policies, one being a universal life and the other being a whole life. A universal life, their performance or the performance of that policy is tied to a crediting rate or interest rate. I can think back years ago, dating myself, but the crediting rate about 35 years ago was 14 to 15%. Now we're sitting at around 4% for a lot of these policies. And let's say that you bought a policy a number of years ago and the crediting rate was 8%. Well, you're paying a premium at that time when you took the policy out. You're paying a premium based on that assumption of 8%, continuing to earn that or higher for your policy to perform as you expected it to when you took it out. The policy will most likely lapse, and policies have lapsed because of the situation where that 8% has dropped all the way to 4%. Even a 1% decrease in a crediting rate can make a substantial difference in how that policy performs. A whole life policy, which is tied to dividends, same situation. Dividends, because of the lowering rates in the last number of years, the interest rate, the dividends have been decreased over the last number of years as well. So people that bought a policy thinking that their dividend would be paid at some rate that they expected is not. It's gone down. The dividends have been reduced. So people that might have thought they could pay 10 years of premiums and they're done, that's not happening. They're having to pay a lot longer. And what's happening as well is that these policies are going to lapse. And it's not really good if you had a policy that you took out thinking that you wanted it enforced till 100, or let's say 100 plus, and it ends up lapsing around 70 to 75. You're not near your life expectancy, so the policy didn't perform up to what you really expected. The way you can kind of make sure that you're not going to be in that situation is to review the policies that you have. If it's a whole life policy or a universal life policy, it's going to be a good idea to review those policies, get what's called an in-force ledger, and it'll show a snapshot of how your policy is performing based on the current crediting rate that it's being given at that time and the premium that you're paying. You'll find that the policy premium may have to be increased, or you may look at other options with other companies and other policies depending on the policy you bought years ago. But it's a good idea to go ahead on universal life, whole life policies, index universal life policies as well, to review those policies to make sure that they're going to last. That's what I'd say is the biggest issue right now with interest rates and insurance companies and life insurance insurers.
Yeah, interesting. So what I'm hearing is insurance is not a set it and forget it kind of product. It needs to be something that you're periodically getting with your insurance advisor and reviewing the policy, making sure it's still working the way it was set up to, and that it's still the right fit for you as things change, income changes, your goals for that product or that need changes.
That's correct.
Robert, Tom mentioned earlier tax reform as being, a headline that we're hearing and talking about. I know there are specific parts to the proposed changes, namely capital gains tax, that's driving some of the conversations you're having with your clients as it relates to valuation on transfers. Can you expand on that a bit?
Yeah, so you're right. There are a couple of things in the current proposal from the president's tax plan regarding capital gains. So one is just an increase in the capital gains rate potentially, but the other one that could potentially have a big effect on families who are intending to pass assets or businesses from one generation to the next is a provision that would call for a capital gains tax to be levied on the appreciation in value when an asset is either donated or when a decedent passes away and the ownership passes to an heir. That's very different than the situation that we have today, where the basis on that asset would step up to the fair market value when it's passed along, and there's no tax bill due at the time. So in this situation, if this provision were to go through, the amount of the gain would be the excess of the fair market value at the time of the gift or at the death of the decedent over whatever their tax basis is. And that gain would be taxable income on either the decedent's gift or estate tax return, or maybe on a separate capital gains return. But I could see situations where this creates real problems. I'm thinking of for example, families that have non-income producing land or a farm or something that has been in the family and passed from generation to generation, and the intent is to continue passing that on as a family asset. And now potentially there would be a tax bill due with the passing of that asset, and to the extent that the family does not have liquid assets otherwise available to cover that tax bill, it could force them into having to liquidate some of the asset or maybe all of the asset in order to cover a tax bill. So it's concerning from a lot of different angles, and who knows whether it will become law or not, but just the prospect of it would represent a serious change. And it makes me think, WP, about life insurance. Traditionally we've had conversations with clients about life insurance proceeds as providing the liquidity for a tax bill. With the estate tax laws the way that they are right now, some of those conversations have gone away the last few years. But a proposal like this that that could create a near term tax liability that's got to be covered, that could put those life insurance conversations right back on the table. Have you heard kind of anyone thinking along those lines or had any conversations like that?
That's come up quite a bit. I think life insurance is an excellent leverage to create liquidity. It's been used over the years, for a number of years, to provide liquidity for estate tax. The same situation you talked about, liquidity. If you don't have the liquidity to pay that tax, you're going to have to sell property and figure out a way to pay that tax within 9 months. Let's say that this does pass and there is going to be a tax due at the owner of an asset's death to their heirs, and it's going to be a capital gains tax. I still say that's a great way to provide liquidity. Let's say you do, like you mentioned a minute ago, you have the liquid assets such as a business, real estate, partnership interest, or other personal property. Your heirs, they may have to sell your liquid asset or assets to pay that capital gains tax. So the way it's set up is you would put life insurance and it would be on the current owner of that asset, with a benefit going to cover the beneficiary's anticipated capital gains tax liability, which is a real simple way to take care of that and avoid from having to sell that property or land or whatever it may be to create that liquidity. So I think life insurance will continue to be either for estate tax, or if we do see a change and we have a problem where it comes to creating liquidity for capital gains, I think it's still going to be something to be used as well.
Yeah, the elimination of the step-up in basis could have huge implications on next generation depending on the type of asset. So definitely something for people to start thinking about and thinking through. If this becomes a reality, then what are my liquidity options, and possibly looking to life insurance to meet that need.
Bree, if I might add, I had a meeting today with a client and an attorney that we were talking about that exact situation. And, I think Robert may have mentioned that, for a number of years now with the elevated exemption credit, those discussions haven't been that frequent because most estates would have fallen under that and it really was a concern. But the problem you have now is there's various versions of potential change. And some talk about retroactivity, some talk about prospective, some talk about enactment date. And as advisors and advising the clients, it's really tough. I mean, you're basically laying the landscape out. We're identifying the opportunities, but it's really hard to pull the trigger and to execute a plan, to underwrite a policy, to go ahead and effectuate a gift or a transfer, because all this may be for naught. I mean, none of this may pass, or it may be worst case or somewhere in between. So it adds just so much complexity. But I think, WP's point is right. We need to be having these conversations and laying out the fact set so that when we have clarity and potentially have a window of opportunity to be able to execute, then we're prepared and able to do that, not miss a chance to provide some real value advice to our clients.
Mm-hmm. Yeah, great thoughts. Robert, you spend a lot of time helping clients work through, valuations of their businesses and assets. I know there's also been some talk about changes to how fair market value would be determined for an asset. Can you talk about what that change is and how it's affecting the guidance that you're providing when you're working through valuations?
Yeah, so this is another component of the proposal around capital gains taxation at the time of transfer, and it has to do with fair market value. Again, the gain at transfer would be measured by the fair market value at the time of the transfer over the basis that the donor or the decedent has in the asset. And traditionally, the Treasury regulations and the tax law have followed a consistent definition of fair market value that has been around for decades. But there's a component of the current proposal in which fair market value is defined differently for purposes of this capital gains tax calculation. And the difference has to do with discounting. So when we are valuing a partial or a non-controlling ownership interest in an asset, so say, for example, someone owns a 25% interest in a business or in a piece of property, it does not carry the benefit of control of that asset. And so from a valuation or an economic standpoint, that has translated into a discount on what otherwise would be the pro rata value portion of the value of the business or the asset as a whole. Well, this definition calls for an elimination effectively of those discounts for purposes of this capital gain tax calculation at the time of transfer. And it just, to me, it has the potential of creating a lot of confusion, because we could have different definitions of fair market value floating around depending on which portion of the tax code we're looking at. And so it's definitely something that has hit my radar and that I'm trying to stay apprised of. But it's one of those things that has made its way out to some degree into the marketplace. And so I have had clients and advisors who have asked about whether or not discounts are going away, and again, thinking about maybe going forward with some of the estate planning strategies that they've talked about in the past, and maybe didn't feel a sense of urgency about needing to do those. Well, now through a combination of all the things that we've talked about here, I think people are feeling that urgency, and rightfully so.
Yeah, I think it's interesting. We each talked about elements of kind of the main issues that are affecting the environment right now. It's interesting how one issue could have really deep ramifications in each one of our businesses. I think if I think about the firm in general, and obviously we've talked about Robert's business and WP's and obviously WP Wealth's, but whether it's tax group or the audit group or a transaction advisory group, I think that's really one of the real values that we have in having all these multiple lines of business that really focus on different things. We could take an issue like capital gains or fair value or interest rates, and it does impact everybody's business. And being able to put our heads together, have conversations like this today, or just network like we do professionally within the firm and servicing and trying to add value to our clients, that certainly is a value proposition that we can deliver to our clients that maybe some other groups can't. So just find it really interesting as we talk about these headlines and how multiple implications that it might have to businesses and to individuals.
Yeah, really great discussions, everyone. I really appreciate hearing from all of your perspective on the ever-changing economic environment that we're navigating, and working through with our clients on the personal wealth side, and how that translates into your service lines as well. I know this is an evolving conversation, so as we continue to get more clarity on some of the agenda items under the Biden administration, economic recovery, Fed's response to some of these concerns that we've mentioned today, we should certainly look to get back together to touch on some of these other topics that we weren't able to address today. Thank you to our listeners for tuning in. Please head to whitleypenn.com to learn about all of the different financial services Whitley Penn has to offer our clients. Also, please like, share, and subscribe to our WP Talks podcast channel wherever you listen to your podcasts. We will see you all again soon.